Hello guys, it's been a while since I made a video about trading. So this one may be the best video that I have, or at least one of the best video that I have ever made about trading. So if you like this video, hit the thumbs up button. And if you're not a subscriber, please subscribe to Slow Life Trading. Okay, here we go. So one of my students sent out a video about 0 DTE. And the question was, is 0 DTE gambling? Okay. And the guys from Tasty Trade, they gave their example of it, an answer of it. So I'm going to give my answer of it here at Slow Life Trading. So the question is 0 DTE gambling? Okay. Well, one of the first things you need to know is, what is 0 DTE? 0 DTE stands for 0 days to expiration of an option, okay, which means the day of expiration. At the end of the day, that option expiration will have no more time left. It will be the day of expiration, okay? So I took notes because I don't want to miss any of my thoughts on this subject. Excuse me. So now that you know what 0 DTE stands for, here at Slow Life Trading, when we're trading, that's what we trade. 0 DTE. Okay. Now, it doesn't say what type of trading that you do. It just said it's 0 DTE gambling. So the answer is, when you just put it out as a blanket question, yes and no. Okay? At least that's my answer. But I'm going to go in detail on these answers. So there's two ways it's more than that, but just go here with me on the simple answer. There's two ways to trade 0 DTE. You can buy the options or you can sell the options, okay? And then you can do these 0 DTEs on a lot of different stocks. Here at Slow Life Trading, I'm not gonna talk about all the other different stocks because we only trade one thing, and that one thing is the SPX. And we trade it the day of expiration, which is 0 DTE, okay? Now, so I'm gonna talk about the SPX, which is the S&P 500. Okay, now, if you do wanna gamble with this, and you can make a lot of money if you win, and you'll lose a small amount of money if you lose, you can gamble it by buying out of the money options, okay? You can get them at a small price. What's a small price? I don't know, $2, $3, $200 or $300. And if it wins, it can turn into, oh my goodness, it can turn into easily double, triple, sometimes 5 and 6 times your money, okay? But to me, you have to, first of all, pick the right direction and either be close to the money, which means close to the price of the stock, and pay a little bit more, or farther away from the price of the stock, which is deep out of the money, and pay a lot less. But there's risk associated with both. If you're close to the money, you needed to move, maybe not fast, but you need to move kind of pretty. You needed to move to the point where your option that you paid, because you're going to be paying more for them. Say you paid $3 for them. Now you need them to pay, you need this stock to move because you need this $3 to go up higher than $3. Okay, so you needed to move pretty severely. What is severely? I don't know, maybe $5, $10, which really for the SPX is not a whole lot, okay, in order to double your money. Or you can go far out of the money and pay a whole lot less. Say you pay $1, but now you needed to move pretty substantially because you're way out of the money. And in order to double this dollar, But what is substantial move? If you get a $10, $15 move, especially if it moves fast, then you can easily double, maybe even triple that dollar and turn it into $3, okay? And if you lose because this is a debit, which means you paid for it, which means you bought it, then the max you can lose is only what you paid, okay? And if you're good at picking a direction of these options, which can be hard to do because just about the time you think it's gonna go up, it goes down. But if you get good at that, you can make some real money. And all you need to win is probably about 4 out of 10 times, which is about 40% of the time. And over time, you will be a winner, okay? How much will you win? I don't know. You probably average about 10 or 15, 20%, okay? Which is pretty good a month. You may average 50% a month. I don't know. And then you also could lose because we're talking about losing 6 times out of 10 or winning 4 times out of 10, okay? And you need to get at least 100, 150, 200% on your wins to make this work. So I think that if you trade that way, that is gambling. Now, let's talk about the ways of which I think is not gambling, and then we're going to go into detail and explain why, my evidence of why it's not gambling. Okay, first of all, if you compare this to the casino, okay, when you walk into that casino, you're a gambler. But the casino is not gambling. And the reason why the casino is not gambling is because with every trade that they have out there that they put on, they have the odds in their favor. It may only be like they have 53%, you have 47%. They have sometimes up to maybe 60%, and you only have a 40% chance. And what they'll do is they'll give you a chance to make more money. Let me give you a quick example. Let's say you have a 35% chance and they have a 65% chance. Well, to balance that out, what they'll do is something like, and we'll just use $100. They'll say if you put down $100, you can make not just 100%, you can make $120. And if they put down $100, they only can make $35, okay? But believe me, they have those odds in their favor, and that's the reason why they're willing to pay you more, because they know over time the numbers play out. The odds will play out in their favor, and they need time because they're going to be there throughout no matter how many times you try to bet, no matter how long it's open, because most casinos are open 24/7. So they got to have these odds in their favor because the rules say they have to take every bet according to the rules on their table, whatever the rules are. If you have a maximum of $100 or a minimum of $20, they have to take whatever bet that you have to make, okay? That's the casino. Now, let's flip that over to, I'm going to talk about slow life trading because this is the type of trading that I know and that I teach, okay? Now, if you sell deep out of the money options, this is not gambling. And let me just break this down. I got me some notes here, so you're gonna see my eyes move away from the camera onto my paper. Okay. Selling deep out of the money, people, if you learn how to sell them right, it's not gambling. Okay, first of all, just a pure simple fact of the thing, without knowing any history or anything, when you get deep out of the money, deep out of the money, most options expire worthless. Well, when you're selling something and taking in money, what you wanted to do is to expire worthless. You want it to go down in price. You want to sell high and buy it back cheaper. Well, you can't get no cheaper than zero, okay? So just pure the nature of the beast, selling deep out of the money. What is deep out of the money? Deep out of the money is going way out of the money, which is, if the price is here, we're going to sell way out here, okay? And you may not get hardly anything for it. And your risk as far as putting money on it, or the amount of money that you have to put up in case this thing loses, is very high. So you're going to be making a small percentage of return. And I'm going to cover that later on in this video. So, but the odds of you winning is probably like 95 or more percent, okay? And the way that I'm teaching here is a little like trading. So even though that amount is small, because you're going to be winning 95% of the time, and sometimes even more than that, most of the time you're more than that, if once you learn how to do this stuff. It's not gambling, guys. You're just playing the odds and playing the favors. And we put everything that we can on our side, okay? So now I'm going to go down some of these things that we put on our side to help us know that we're winning and not gambling. Okay. First of all, we know how to calculate what the expected move of the market is, okay? And when you know what the expected move is, you just move beyond that. Okay? And when you know what the expected move is, and they got this thing that they call the delta, okay? The delta is something that gives you your probability of winning. Well, we try to play with deltas of like a 95% or better probability of winning. Okay? Now, in doing that, sometimes we don't hardly make any profit. Our profits are very small. Okay? But we exchange small percentage on profit for consistency. And the reason why we can take a small, because some people would say, man, you're taking such a small percent of a profit. If you lose, you're going to give all your money back. Okay. We exchange taking this small profit for two things. Number one, being able to win 95 or better percent of the time. And number two, for being disciplined. We have an exit price in our mind already set for when we go into the trade. And we're not going to lose no more than that. Or we definitely going to try not to lose no more than that. Okay? Okay, the expected move. We know the expected move and we know the deltas that we want to play in. And then if you know how to use charts, we got this thing that we call the 200 simple moving average. And it doesn't help you all the time, but it helps you most of the time, okay? To me, the 200 simple moving average is the divider line between up on the market that day and down on the market that day. So what we do, because we're playing what we call credit spreads, which is selling first, what we do is see where the 200 simple moving average is, and this is a line, okay, that's on the chart. If the stock is above that 200 moving average, we try to get a credit down here below it. And as long as this stock stays above this price, we win, okay? So that's another thing that we use. The expected move, the delta, and the 200 moving average. And then we have an exit price of how much we're trying to make. So we don't have to stay in these trades all day necessarily. Sometimes we will because we're winning so well until we just ride it out to the end of the day and let it go to zero. And let me give you an example. Let's say we take in a credit of $30, okay? For us, if we take in a credit of $30, we're only trying to make 1% or less, okay? A half to 1%. So we're looking to get out of this trade at somewhere like 20 cents or 15 cents. If we get out at 20, that's going to let us make a 0.5%. If we get out at 15, that's going to let us make 1%, okay? Now, those numbers sound really tiny, but again, we're basing them on winning over 95% of the time. And if you make a 0.5% in a month, which you average about, 10, 20 days or something like that, you're going to be making over 10% a month. And if you make 1% a day, you're going to be making over 20% a month. okay? The market on average returns anywhere between 8 to 12% a year. So we're gonna be producing in a month what the market produces in a year. And keep in mind, we're playing the market. The S&P 500 is, for the most part, the market. Okay. The other thing is we have an idea of the news that is expected that day. The biggest thing that makes the market move is news. I don't care what nobody tell you. Know that. I don't care if it's the earnings report. I don't care if it's the jobs report. I don't care if it's the Fed coming out talking. I don't care if it's because the war is going on. We don't hear about it until they report it on the news or you read it in the news, okay? So the biggest thing that moves the market is news, okay? It's all chopped up to news. Well, guess what? We try to know the news before the market opens by reading, things that what the market is expecting to be reported that day, okay? And if we see a situation where the news is going to be really, really big, we don't trade that day, okay? Years ago, a few years ago, we had a president that would speak a lot of times during the market and while it was open. And because he based a lot of his success on how the market was moving, when we knew that he was going to speak, we didn't trade that day, or at least we waited till after he spoke that day before we made a trade, because sometimes you couldn't tell if he was going to be speaking good about the market and make it go up, or speaking bad about the market and make it go down. And then also, we know that the Fed chairman, whenever he talks, he have a tendency to move the market big. So when we know that he's talking, we stay out of the market. And it's okay to miss a few days a month, okay? Okay. One of the other things we look at is the VIX. The market has way more technology than what the average trader has, especially the average Joe Blow trader. So what we do is use the information that the market has. Well, one of the things that they put out there is the VIX. What is the VIX? The VIX is the fear indicator. And they have two, and they call it volatility. They just say VIX for short. Well, there's two types of volatility. You got historical volatility, and that's published just about on any financial channel, Yahoo's, MSNBC, CNBC, Fox, whatever it is. It's published what the VIX is. That's historical volatility. The other volatility is called IV, which is implied volatility, which is looking forward. What does looking forward mean? When you look in your mirror and you're driving, you see stuff that already happened that you done passed. But when you looking through the windshield, you seeing stuff that could happen, which is in the future, okay? Well, historical volatility is looking in the mirror. Implied volatility is looking forward, which means they're anticipating, okay? That's kind of what the expected move is. Well, they don't give us a number, at least I don't know how to find it, what the implied volatility is, but you can see it in the price of the options. For instance, the other day, last week, the CPI number was expected to come out. And typically, the expected move for the day may be something like, I don't know, let's just say 50. Well, because they knew that the CPI number was going to be something big that's going to happen and make the market move that day, the expected move went from 50, which is kind of, let's just say average what it have been, to 75, okay? That's stuff that we can use that the market put out that we have no way of calculating. So we just use that to our advantage. And what do they do with that? What they do is they jack up the price of the options, okay? So if you're a buyer at that point, you're gonna have to pay more for your options, which means the stock is gonna have to move even further for you to be profitable. But if you're a seller, what that allows you to do is move further away from the price of that option, okay? And collect the same kind of money, and it makes you safer. So these are the things that we are using, okay? Now, that's news and implied volatility. And then when selling, we're playing on the side of the house. But we can exit when we want. Okay, remember how I told you in the casino, they're open 24 hours and they have to take all bets, okay? Well, just the same way with the market. When the market, the real stock market, they have to take whatever trades people put in there if they're willing to pay the market price, okay? Well, because we're not a market and because we're small and we're little Joe Blow, we can decide which trades, which strike price we want to take. And we can decide when we want to exit. And that's what I was telling you about. So even if you have a 99% chance of winning, let's just say, right, on a trade, and they basing that 99% win on you staying all the way to the end of the day, we can get in for this thing for, say, like $30, and then when it get to $20 or $15, get out of the trade. Or we can decide that it's looking so good till we get in this thing for a $30 credit and we ride it all the way to the end of the day when the market closes that day and it goes to zero. The choice is up to you because even though we're playing on the side of the house, we're not the house. So we don't have to stay to the end. We stay till we want to get out, okay? And also we stay the other way if you're losing. If you sold this thing for 30 cents, we got to have an exit price of where we want to get out. So if it goes to 60 cents or 70 cents, which means it's going the wrong way, or even $1, we have a price in our mind to where we're only willing to risk a small amount. We're not going to risk all of our money saying that we got to be right. Okay, we hope that we're right and we got the odds in our favor that we're right. But if we're wrong, we have an exit price already set. Because this strategy, I call this strategy the golden goose, okay? This strategy wins so much, the hardest thing for you to learn how to do is to learn how to win properly. Once you get that part down, where you know how to lose, it's all about winning from that point on, okay? Let me go to my next one. With slow life trading, we're only trying to, I already told you this before, we're only trying to make anywhere between 0.5% to 1%, which means that we can either do one or two things. We can get in and get out and make our money, or we can go so far out until they're not even worried about those options, okay? They just say, okay, we just let that. You know how you have a table and you just let the crumbs fall off the table? And you just say, oh, I ain't worried about that, eating that part. That's just the crumbs. Well, what we're trying to make is almost like the crumbs. And they don't even worry about us, okay? But it's enough for us to make not only a living, a great living. You figure what 10% is on the kind of money that you have and calculate that over the next 10% a month. Calculate that over the next 5 years and compound it. You'll see what I mean. Okay. Okay, another thing here is we don't treat every day the same, okay? Because we know every day is different. Some people want to make trading black and white, and they want to treat every single day the exact same. Every day is not equal. Some days you have big news, some days you have small news. Some days the people already know it's going to be a quiet day. So the market don't move that much. With credit spreads and with the golden goose and with slow life trading, we have figured out how to make money even when the market is going sideways. Or even when it's a choppy market, it's going up, then it go down, then it go down, then it go up, then it go up, and it look like it's really going to take off, and then it come right back down. We had this type of day just yesterday, okay? So, but with all of that, we have figured out how to make money doing that, okay? Okay. Now the amount of money we may make may not be much. Like I said, 0.5 to 1%. But 0.5 to 1% on a day when the market ain't moving is better than not making nothing. Okay? And it's another egg in your basket. Okay? And and usually when the market is just going up and then down, and going down and then going back up again. Those are easy gravy days for us, okay? The only easier day than that is when the market is really shooting up and we underneath it, or it's really shooting down and we're on top of it, okay? But those are easy days for us. So really, and I'm gonna be honest with you, the hard day for us is when the market shoots way up and then it does a reversal and come way down. Or it goes way down and it does a reversal and go way up. And for those days, that's when we have an exit price that we're willing to get out of it at, okay? And those days do happen. But here's the other key part about it that I didn't bring about. We know that a lot of the news of the market happens in the first 1 hour of the market being open. So a lot of times when we're trading, we don't even trade until after that 1 hour is done. And we see which way the market is going. Okay, and once we figure that out, and we know that, again, by that 200 simple moving average, for instance, right? Let's say the market opens up and it's above that 200 simple moving average. And then after about 30 minutes or an hour, so it has a tendency to either bounce off of that number and then go up, or then break through that number and then it heads down. Well, at that point, that's when we put our trade on and get above it. At first, if we wouldn't have waited, we would have got below it, okay? And then the sucker does a reverse on us. But when we wait that hour and give the news time to absorb through the market, and then the market decides which way it wants to go, that's when we put our trade on, okay? I'm telling you, as slow life trading guys, we got a couple of strategies that I call the backbone of slow life trading. One of them is a compound collar, which I'm not talking about on this video. We're talking about 0 DTE, which is it gambling or not? And the other one is my golden goose. All the other strategies that I have outside of that, which there are more, we just use that to make our profits even bigger. Okay? Okay, here's another thing that we do. With slow life trading and with this golden goose, you can get so far away from the price on one side and take in some money. But let's say you don't know which way the market is going, but you want to make a little bit more. You can go way on the other side and go way far away and take in some more money. And the cool thing about this is, you ready for this? You can use the same money to place both of these trades, okay? Which means you almost like build a fence around the S&P 500. So, and this is perfect when the S&P 500 is choppy or going sideways. Choppy means it's just going up and then down, up and then down. And then sideways would mean when it's a slow market, it's just barely moving, $3-4 up, $3-4 down, just kind of going sideways. Choppy could mean it's going up $10-15 and then coming down $10-15, okay? But in those situations, you can play both sides, go way, way out on the fringes, and then just let these numbers go to 0. And when they go to 0, we get out of them. Or we ride it to the end of the day. Either one. Okay? That takes away the gamble. And I told you we put the odds on our side. We're trying to play these trades with a 95% probability using the delta. And when you're in slow life trading, I'll teach you how to do these things. I'll teach you what delta is and where to find it. I'll teach you how to decipher the VIX and the IV and how to use it in your favor. The market uses IV. I'm sorry, not IV, AI, artificial intelligence. So they don't have to have some super smart person to help them protect themselves against things that can happen, okay? So what we do is use what the market is using. We don't have to have it. We just use the information they have. It's a law that the market has to publish information at the same time to everybody, okay? If you learn how to use it and put it on your side, you're not gambling. You just learn to get better and better and better at using that information. It's going to make you a more successful trader. And know that when you're wrong, get out at a certain price. And don't disobey these rules. Okay? Okay, now. I already told you that most deep out of the money option expire worthless. Okay? Now, I'm going to tell you the one that really is important. And this is the one that's sweet right here. When you're buying an option, okay, with options, it's something that will expire. We're talking about zero DTE. So at the end of the day, these options expire. So you have a time limit for this thing to work or not work. When you're buying, you need this thing to move in the direction that you want it to move in. And you need to do it because every minute, money is coming out of the price of the option. If it don't move in your direction, the price that you paid is getting smaller and smaller, even if it just sits there. It's not like a stock. If a stock don't move, the money you paid stays the same. But with an option, if you buy an option at say $30 or say $100, and the price just sits right there and don't move, because of time decay, the price of that option is going to get cheaper and cheaper and cheaper. Okay? And that's bad if you're buying that option. But if you're selling that option, what you do is you put time decay on your side. So not only is the price right here, you're trading way up here. If it moves up or stays the same, time decay is because these things are zero DTE and they're going to expire at the end of the day. Just because of that, the price is going to get cheaper and cheaper and cheaper just because you're getting closer and closer to the end of the day. Okay? So even if it moves up, but it's moving up slowly, or even if it moves fast, but then slows down, but it don't come up to your price, the option is still going to start decreasing in price. So when you are a seller of options, you put this time decay on your side, which again means you're working with the market, not against the market. You got the market working in your favor. One thing I learned during the NBA strike and the NFL strike, when the players were striking to get more money, sometimes they got a little bit more money, okay? But you can just about bet that the owners won even when the players won a little bit more. And here's why. And this is just my own little theory of thinking. The owners are billionaires, okay? And the players are millionaires, most of them. Billionaires can sit and wait without making money longer than a millionaire can sit and wait and not making money, especially if they don't manage their money right, okay? So with an option, if you get on the side of the market, you're going to be on the smartest side. Because even with this deal going on with unions versus the CEOs and the bosses and the owners and all that kind of stuff, even when the players, the workers get, well, they're never going to get 100% of what they want. But even when they win, the worst it could be is a win-win because the owners are not going to lose, okay? And the reason why they're not going to lose is because most of the time they can sit and wait without making money more than the strikers can sit and wait without making money, okay? And even if they can't, they can go hire new people. Because there's a lot of people out there that are willing to work when the union people won't. It takes time to train them, but it can happen. I think that the workers should get more money. Hey, but it don't matter. It depends on which side you're on. It don't matter. The owners are going to win no matter what. okay? Even when the workers win. So, time decay, let me get back to that. Time decay, we put it on our side, okay? And then here's one that I don't talk about much. And you may not understand this much when you're trading. When we trade what we call spreads, okay? And what is a spread? Spread is when you put two option strike prices together. Well, when you do that, it limits the amount that you can lose, whether you're buying or selling it. It also limits the amount that you can win if you're buying, okay? But when you know that you're at the point where you're gonna be winning more and more and more and more, what you have to do is get it to the point where you can limit the amount that you're losing. And so using spreads, which is something else that I teach in slow life trading, is another way of putting selling on your side, okay? Okay, I got two more things to cover here. And I've covered them a little bit, but I'm gonna go a little bit more in detail. Is learning to be happy with a 0.5 to 1%. Because if, let's just say you're trading, I like to use a number like $10,000, okay? And here's why I use $10,000. Let's just say for every $10,000, that's like having a rental property. If you can make 10% on that $10,000 every month, that means every $10,000 is gonna produce you $1,000 a month, okay? I like to use those numbers. Okay, well, when you learn how to make, and that's at a 0.5%. If you make 1%, every $10,000 will produce you $2,000 a month, okay? Now, I know there are some people out there that's saying, oh, $10,000, that's a lot of money, okay? But the cool thing is, when you trade the way that I'm teaching you how to trade, with that $10,000, all you're gonna risk is about 10% of that, which would be $1,000, which means you're only trying to make for that month what you're risking, okay? That's a sweet thing. And if you're making 1% a day, you're risking $1,000 to make $2,000 for that month. Okay, so in saying that, if you can learn to not look at what you're making per day and start looking at what you're making per month and what you'll make in the next 6 months, you will see, because even when you start a job, right? We don't even realize we do this. But when you start a job, they tell you how much you're gonna make an hour if you're getting paid by the hour, or they tell you how much you make annually. Well, if you take a 0.5% and figure it up, 0.5% a day, and figure it out how much you're gonna make annually, you're gonna make about 200%. Basically, you're gonna take that $10,000 and turn it into, you ready for this? $40,000. Because at 10% a month, and you compound it, your money is gonna double about every 6 months. So that will be going from 10,000 to 20,000 in 6 months, and from 20,000 to 40,000 in a year, okay? You have to learn with this strategy to be able to look down the road. And when you look down the road, you will see that making 10% a month is really awesome. And I still didn't talk about making the 1% a day, which is making 20% a month, which means your money is gonna double about every 3 months, okay? I'm sorry, every 4 months. So now, instead of having 2 doubles a year, you'll have 3 doubles a year. So if you can get to the point where you learn how to make 1% a day, which is 20% a month, every 90 days, your money's gonna double. I'm sorry, every 4 months, your money's gonna double. So that would be like taking 10,000 in 4 months, turn it into 20,000, and then in 8 months, turn it into 40,000, and then in 12 months, turn it into 80,000, okay? But you have to first get good at learning how to first learn what you're doing, then learn how to paper trade, then learn how to make a 0.5%, and then maybe you can move it up to the point where you learn how to make 1%. But even if you don't, and you just stick with 0.5%, just get good at that. But what we use to help keep us disciplined in following this is we have to be able to raise up our head and look down the road and know what this thing is going to do. We do it all the time on our jobs, okay? When we're making $100,000 a year, we're not necessarily looking at what we make per hour or per day. We're looking at what we make per year. Well, you need to do the same thing with this. Don't look at the 0.5%. Look at what you can make a year, which would be 200%. Or don't look at 1% a day. Look at what you can make a year, which would be 300%. No, it's not. It's not even that. It's more than that. Because we're talking about 10,000 and turn it into 80,000 at 1%. That's like 800%. Okay? And we're talking about at a 0.5%, taking 10,000 and turning it into 40,000. That's 400%. I got the numbers wrong. So you have to be able to look down the road and see how powerful this is. I could come out there and tell you, like a lot of people do when they're trading debits, we have learned how to take $1,000 and within a few hours turn it into $3,000. Can you learn how to do that? Yes. Can you learn how to do that on a consistent basis and every single day? No, it's not going to happen. Number one, even if you know how to do it, the market doesn't move that much every day, okay? With slow life trading, I'm going to teach you how to make money whether the market moves or not. And I'm going to teach you how to do it without looking at 20 different stocks. We look at one thing, the S&P 500, and we learn how to take the knowledge that the market has already put out there and use it to our advantage, okay? That's what I'm teaching you here at Slow Life Trading. Don't let the small percentage per day mess you up and keep you out of this. Because you're making these small percentages a day, you're going to make large percentages per year. Keep that in mind. And because it wins in the high 90% of the time, if you want to do some of these strategies, okay? And this is all why I'm telling you it's not gambling. If you want to gamble and do some of these strategies that make you this crazy amount of money, take some of the profit of your stock that's moving and winning on a consistent basis, and don't use all of it because then that'll turn you to a not profitable day that day. Use part of it. So even if you lose on those other trades, you still will win at the end of the day. Okay? This is what I'm teaching people at Slow Life Trading. This kind of stuff can make a world of difference in the next 2, 3, 5 years. Okay? And I'm only talking about one strategy. There's more out there for you to learn with Slow Life Trading. And the last thing that I'm going to cover, this may be the most important thing of all. This is why you paper trade. This is why you start small and gradually move up. This is everything. Being disciplined and getting out of a trade that's losing. Okay? It don't matter if this trade turns around and turns into a winner or not. That's not important. Because the one time that it won't could cost you more than you're willing to pay. Okay? But if you learn how to get out of these trades at the number that I'm telling you how to get out of, you may massage it and play with it a little bit and give it a few more points and give it a little bit more than that, a chance to go down. But let's just say, with all that, you learn how to get out of these numbers. If you learn how to be disciplined and exit a trade when you're supposed to exit a trade, I'm not talking about exit a winning trade. I'm talking about exit a losing trade when you're supposed to. That's where you got to be disciplined at. If you learn how to do all of that, don't take crazy chances unless you're taking it with profits that you made from these credit spreads, the golden goose strategy. If you learn how to do that, which is I'm trying to teach people how to do, one person at a time, with some individual attention and with classes that are going on twice a month that are live, where you can ask me questions whenever you want to in this class. And you can email me 24 hours a day and ask me questions that I personally answer, not a staff, me. If you join me here at Slow Life Trading, I can teach you how to do what we just covered and go from either not trading at all in the market and being afraid of it, or if you're already trading, not gamble. Learn how to trade like the professionals trade and learn to be able to make a living from day trading, okay? Along with everything else I'm teaching. But you'll go from gambling in the market, being a buyer, to not gambling in the market on zero DTEs, and making profits on a consistent basis daily. Okay, guys. So to sum this up, I want to say this. Zero DTE trading, the way that we trade it here at Slow Life Trading, is not, absolutely not gambling. And you will build confidence in yourself, and you will learn to know that it's not gambling. Okay? No, it's not gambling. That's it. If you're interested in learning more about Slow Life Trading, check the box down below, open it up and see more, and you'll see where you can go and register to get on my email list. Okay? And if you want more than that, you can join us here at Slow Life Trading and become a member, a lifetime member, for one price. And when you sign up for Slow Life Trading and you come in for one price, I don't sell you stage 1 for this price, and then once you get in, sell you stage 2 and then stage 3. No, it's one price, guys, one price. When you come in, you got me. A long time ago, when I used to go to these seminars trying to learn how to trade, I paid this price. And then the first day that I went to the seminar, the first thing they started trying to do is upsell you to another price. I'm here to tell you at Slow Life Trading, there is no upsell you to the next level price. Once you come in, you're in. You get it all. Anyway, guys, go to the link down below to Slow Life Trading. If you're interested in what I'm talking about here and you want to learn how to do this, join us at Slow Life Trading, where I can teach you how to not gamble with zero DTEs. Again, thanks again. Peace out, and I'll see you on the other side.